The great growth to value rotation continued for its second straight day, and we had quite the divergences taking place within the market itself. The Nasdaq has been front and center of this rotation, with many of those work from home types of stocks and others that benefited from the coronavirus really selling off hard in the last couple of days since we've received that vaccine news from Pfizer. And we've seen that money rotating into areas like small caps and banks and oil companies. So a lot to discuss here today. We'll see how that changes our posture, if at all. And then we'll get into a trade application example where I wanted to focus on a sector that is falling out of favor for a bear call spread. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's November 10th. 2020. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe on our channel. While you're there, check out our description down below and sign up for our email distribution list. We're also heavy users of Twitter. Feel free to follow me at Brandon Van Zee. Also, we appreciate those of you that click like and retweet on these Market Outlook related tweets. And then last but not least, we do have a presence on Facebook as well. Feel free to join our group at that web address you see in the logo in front of you. All right, let's jump into today's activity. And as you can see, I've got chart 4B pulled up here in front of us. And for those of you that are newer to this video, this is just a 4-grid that will show us the market forecast technical indicator on 4 different major U.S. equity indices. So we have our S&P 500 in the upper left, Dow Jones Industrial Average in the upper right, Nasdaq Composite in the lower left, and the Russell 2000 in the lower right. And we had some divergences here today. We saw the Nasdaq down over 1% today, so that's a pretty aggressive day for the Nasdaq. On the exact same day that we have the small caps up nearly 2%. They were up 1.87% to be exact. So this kind of tells you the tail of the tape here in the last couple of days. Look at these 2 candles right here on the Nasdaq. Both ugly red candles, big sell-off days. At the exact same time, look at the same 2 candles on the Russell 2000. Both big kind of empty or clear, however you want to describe that, candles. In other words, it represents an up day for that particular chart. So, we are seeing a transition afoot right now. In fact, we had a long conversation about that today in my dividend growth investing class, where a week ago we were feeling like we were really struggling comparatively compared to other strategies, and just 1 week later it feels like we just hit the lottery in the last couple of days. And I think those of you that have longer term stocks in those banks and other types of companies that have kind of been held out of the rally for most of this year, you've probably recognized that robust move that we've seen here from the markets and that rotation that's been taking place. As mentioned in the intro, it's this idea that now that we have more concrete news about that vaccine from Pfizer and the anticipation of that vaccine becoming largely available by next spring, money has been moving very, very rapidly here. And it has been fleeing the old Zoom videos of the world and your Pelotons and your Chewies and those types of companies that were kind of viewed as coronavirus types of plays. And it is violently moving into those left behind areas like your banks and your oil stocks and your industrials and materials and other things like that. So it's been really fascinating to watch here. Now, in terms of whether this massive rotation has changed our posture, strangely enough, the answer at this moment in time is still no. You will notice that all of our charts have this dark green background color, telling us that we still have a strongly bullish posture. And that goes for the Nasdaq as well, where we've seen the biggest of the selling. Now remember, the S&P 500 was also down today, just not nearly as much. It was down 0.14%. The Nasdaq was down well over 1%. So despite the back-to-back sell-off there in the Nasdaq, the green line on the market forecast is still pointed higher, and it is still above the chart's 50th percentile, so we still have a strongly bullish posture on it at this moment in time. fact, those of you that have been waiting for some sort of a pullback there, maybe you're going to use this as an opportunity to find some stocks that have maybe been thrown out, with the babies with the bathwater, so to speak. What we can say is that right now we do have what's known as a bullish intermediate confirmation signal on the Nasdaq at this exact moment in time. And that occurs when we have the green line positioned bullishly, in other words, trending up or just simply in the upper reversal zone, and the red line is in the lower reversal zone on the exact same day. So we have that set up here on the Nasdaq. We also have that set up, somewhat surprisingly, on the Dow Jones Industrial Average. Notice that the green line is trending up almost into that upper reversal zone, and the red line is in the lower reversal zone at this exact moment in time. Now, what distinguishes those two is the blue line. And as David and I always mention in these videos, the blue line isn't technically part of the intermediate confirmation signals, but it can be used as a good gauge to determine whether we have more ideal setups or less ideal setups. And as it stands right now, we actually have less ideal setups with both of the charts, but for two kind of opposing reasons. We like the blue line to be between 50 and 20 on these bullish intermediate confirmation signals. Here on the Dow Jones, the near-term line is at 64, so it's not between 50 and 20. In other words, it hasn't really sold off enough to produce an exceptional buy the dips opportunity. On the flip side, if you come down here and look at the Nasdaq, its blue near-term line is at 10. So again, not between 20 and 50, but for the opposite reason. In this case, it's almost sold off too much. It's been a little bit too aggressive of selling there. Now, I think you can kind of come to terms with that by also looking at the chart and using your technical analysis and recognizing that, hey, we've got this long lower shadow on the Nasdaq here today, and it bounced up and off of that rising 30-day moving average. So that is at least a positive sign. It's a place to start. So be aware we do have those bullish intermediate confirmations, even though they are of the less ideal variety. So a very strange day, one in which we saw the Dow Jones and the Russell 2000 close nicely higher, and a day where we saw the Nasdaq get hit pretty hard once again, and the S&P 500 finish just a little bit down. But despite all the variety in the price movement today, all of our charts from an intermediate term perspective continue to have a strongly bullish posture. Now, one of the things that I was tweeting about earlier today was what was happening from a factor perspective. And remember, we're going to have that conversation tomorrow morning in my factor-based swing trading class for those of you that are plus and premium subscribers. Each Wednesday we get together and try to identify any rotation that's been taking place. And oftentimes it's pretty hard to find legitimate rotation. This week, that is not the case. Let me show you an exhibit of that. So I'm going to come over here and look at our Factor 6 grid. And one of the things I mentioned on Twitter today was one of these things is not like the other. And what I was referencing was the fact that momentum, so that's your factor in the upper right-hand corner here, is trading below its 30-day moving average. Notice that all of the other 5 factors are trading above their 30-day moving averages. And momentum was down significantly today. It was down 1.4% according to my measurement. It wasn't the only factor that was down. Quality was down just a hair, but you could really call that flat. It was down 0.04%. But you're seeing big time movements in some of the other factors. Notice dividend yield. It was up 1.7% today. So like I told my dividend class here this morning, it felt like we've been walking through the desert for 40 days and 40 nights, and we finally reached the promised land of milk and honey. That's what the last 2 days have felt like for dividend investors that have been just waiting for at least one little glimmer of hope that their strategy is going to eventually work. Well, we finally received that in a big, big way in the last 48 hours. All of a sudden, dividend yield looks like it's one of the leading areas of the market. You'll notice that it's up 4.87% over the last 1 month, only to be outdone by value, which is in the lower right-hand corner here, which is up 5.53% over the last month. So value is leading over the last month. Dividend yield is in second place. Surprisingly, momentum is down 4.4% 5% over that last 1 month period. And I say surprising not because it can't move around a lot. I think we all recognize that momentum is one of the most volatile factors out there. So it can definitely move around. That's not the surprising element. What is surprising is that momentum had been a leadership role up until basically Friday, and so things have kind of fallen out of favor for it fairly quickly. And I should take that back. A week ago when we were in the factor-based swing trading class, momentum had already fallen from the top slot. So some of you will recall me even mentioning that in this video. That low size had taken over momentum on the top of my factor selector. So we had that first little inkling, that little heads up there that something was amiss with momentum. And in the last week since that, falling from its top perch, it has only gotten worse in a big way, particularly the last 2 days. And most of that is as a result of the news, right? It's not something that was particularly obvious in hindsight, other than the news happened to hit on Monday morning, and the financial markets reacted quite violently to that news. And depending upon what side of the coin you were on, you either had a big smile on your face or a big frown on your face. If you were in the value and dividend stocks, you probably have a smile on your face. If you were in those high-flying momentum stocks, you're probably feeling a little bit of pain in the last couple of days. There's just no way getting around that. So anyway, a massive reversal that took place there. And another thing that I would point out, let me bring up a different chart here briefly. Now this chart, just so you guys are aware, those of you that are premium members, it has not been released yet. This is the sector selector chart that I've been working on with Mike Emerson. He's done a fantastic job with some of the think scripting skills required for this. So this isn't available yet. But as I've told you guys multiple times in my Monday top-down trend trading class, it will be available to you by the end of the year, along with some additional resources that we use specifically for that class. Again, that's if you're a premium member of Market Scholars. So if you needed some motivation to step up your financial education, maybe getting access to some of these new charts would be one of your motivations to do so. So make sure you're checking out our subscriptions if you have any interest in that. But anyway, I wanted to bring this up here today, even though I haven't quite released it yet, because it really kind of describes what is happening and shows some additional features as well. So what you're looking at here are the 11 different sectors. Now, the way that I'm ranking these, first of all, is based off of an equal weighted philosophy. It is not a market cap weighted philosophy. And it basically is measuring 5 different time periods. I call it my weighted aggregate return score, or WAR for an acronym there. So if you ever hear me refer to a WAR score, that's what I'm referring to. And we're looking at 5 different time periods: a 1 month, a 3 month, a 6 month, a 9 month, and a 12 month time period. So all of them have some impact on the final score, but we are weighting the more nearer term time periods, like the 1 month and the 3 month, more heavily than we are weighting the 9 month and the 12 month. But it is a way for us to at least rank different securities and try to gain a sense of whether there is a rotation that's taking place or not. Now, traditionally, when you guys have seen me post this to Twitter and other areas, I'm just giving you a screenshot of what's happening at one moment in time, typically on the weekend. But the new enhancement to this particular script, which is pretty cool, is that we can actually see what direction the rankings are heading on an intra-week basis. And while not every week is going to come with, violent moves up and down, this is one of those weeks where we do see that. In fact, this pink background color right here is actually being plotted to alert us visually that we have more than average rotation taking place from a sector perspective right here, right now. And you can kind of see where some of those rotations are taking place. One of the big ones from a negative perspective is technology. Notice that technology was ranked way up here in the number 2 slot last week, but in real time, as of this exact moment in time here on Tuesday, technology has fallen all the way down here to the 5th slot. Now, you might be wondering, well, if technology is falling, who's gaining because of that drop? And the answer is very clear to me. It's the financials. The financials last week were ranked number 8. And you can kind of see this dotted line going up here and ending right here at number 4 is the financials. That is a huge leap, particularly for an area like the financials that is one of the largest sectors out there from a components perspective. So that is a massive, massive move that we are seeing on a week-over-week basis. You traditionally don't see rotation taking place this quickly. This is a massive move. This is one of those once-in-a-year types of moves that we're witnessing right here, right now. And, you know, if you guys looked at like JP Morgan yesterday, JP Morgan was up like 12 or 14% just yesterday all by itself. And it had nothing to do with company-specific news. It didn't have an earnings report or anything along those lines. It was just ripping higher based off of this rotation that's taking place right now. And at the same time, you're seeing stocks like Zoom Video and other technology types of stocks that are down 20 or 30% in just 1 week's time. These are violent rotations that are taking place. So I wanted to at least show this off briefly to give those of you that are premium members of Market Scholars an idea of what's coming your way, some really cool tools that we've been working to develop for you. So be on the lookout for that, and I'll alert you to the point when they are available for you to import into your own Thinkorswim platforms. Anyway, let's get back on track here. Before I get back to the Thinkorswim platform, I do want to say thank you to those of you that clicked like for me. The last time I did the video, I always strive to get to triple-digit likes on Twitter. I got to 108 this last time around when I did the video on Thursday. So thank you very much for that. I really appreciate that. It helps David and I spread the word about our fledgling company to a much wider audience than we would be able to on our own. So if you want us to continue to do these free YouTube videos every day, the one way that you can help encourage us to do that is by clicking like for us there on Twitter or whatever social media platform you prefer. But David and I tend to pay attention to Twitter a lot more. So that's kind of what we use as our measuring stick of sorts. So thank you for that. And again, for those of you that are looking for additional education, if you're a Plus or Premium member, remember that I taught my dividend growth investing class today. One thing, if you haven't watched those dividend growth investing classes for quite some time and you're looking for something to do, maybe pull up the dividend growth investing class on our Trading Rooms calendar from 1 week ago on November 3rd and look at my account balance and the stocks that we had in it at that time. And then pull up today's recording if you want to kind of get a sense of how violent this move is that we have witnessed, and a positive violence in the case of the dividend class, where we were sitting on losses a week ago and went to massive gains in just 1 week's time. Remember, 1 week ago, we didn't even know what the result of the election was going to be. So we've had a lot of news hit the wires here in the last week, and for the most part, it has started to benefit some of those areas that had been left out in the past. So again, make sure you're taking advantage of all that premium content there. David's actually going to be teaching 2 classes tomorrow because he had some technical difficulties with his one class today. So he's going to kind of double up tomorrow. And then I'll also be teaching my factor-based swing trading class tomorrow as well. So whether you're interested in swing trading, in directional option strategies, or options inventory trading, we've got a jam-packed day for you here tomorrow. So make sure you're checking that out. All right, let's get back on over to the platform. And let's take a look at some 12 grid analysis. I wanted to bring up a chart that I don't bring up all that often. I probably should bring it up more. Sometimes I'm not really thinking about it. But this is a moment for us to have a chat where it is a bit more impactful. These are our ratio charts. So this is chart 5Q for those of you that are premium members that have access to all of our custom charts. And this will give us a good sense of when we have major rotations taking place. It should be somewhat evident in these types of charts, because in ratio charts, you're constantly comparing one ETF to another ETF, or one stock to another stock, or one market to another market. And if things are status quo, you traditionally have either a trend that is a continuation of a trend, or you just have sideways movement. When you have a major rotation of money, like we've been seeing in the last 48 hours, then you start seeing violent counter moves in the charts showing up themselves. And that is the case of what we are taking place or what we are witnessing right now. So some of those areas, let's start in the lower left-hand corner here. This ratio chart is growth stocks divided by value stocks. And as most of you are aware, 2020 has been the year of the growth stock, particularly those work-from-home stocks and those exciting e-commerce plays and all that kind of stuff. So for the most part, if you were to look at this graph over a long period of time, this is only 3 months here, but for the most part, growth stocks have been trouncing value stocks. In fact, let me see if I can pull up like a 1-year chart. Yeah, so that's what a 1-year chart looks like. Let me see if I can, I don't know if I can actually expand this one, so my apologies. Right now, I'll just show you in the lower left-hand corner here. It might be a little bit hard for you to see, but I think you get the gist. This is the 1-year look-back period on growth stocks divided by value stocks. And it hasn't even been close. I mean, growth stocks have absolutely been destroying value stocks for the last year. Now we zoom in from a 1-year view to the traditional 3-month view, and you can see things are changing quite rapidly. On a 3-month look-back period, it's about even. Your candle here today is effectively at the exact same place where the candle was 3 months ago. If we were to change that to a 1-month period, then the shape of the chart looks completely different. Now you're in this major downtrend right here. In other words, growth stocks are woefully underperforming value stocks in the last month, despite value stocks woefully underperforming growth stocks over the last year. In other words, there's a transition that has been taking place in the last couple of sessions. In fact, you could claim that that transition has been in place for the last month if you look at this chart. Again, this is a 1-month chart that we're looking at right here. And when the chart is tilted down like it is consistently over this 1-month period, it's basically saying growth stocks are underperforming value stocks over the last month. It's been violent the last 2 days, but this isn't something that kind of came out of nowhere in just 2 days, right? Like I mentioned already earlier in this presentation, we already had a heads up a week ago on Wednesday in my factor class that momentum had fallen off of its top ranking. It wasn't dramatic at that point, at least compared to what we're looking at now. Now it's dramatic. A week ago, we had just noticed that there was some slippage that had taken place. Now we can see the follow-through of that wear and tear that the momentum stocks and the growth stocks have seen. So that's one thing that you're really going to want to be aware of as a takeaway from tonight's video. There's a major rotation taking place. We don't know if it'll last forever, but what we do know is that going back to this 1-year time period, this is major outperformance by growth stocks. In other words, if this is a legitimate move that we've been experiencing here over the last month, there's a long ways for that to go. In other words, there's a long ways for value stocks to outperform growth stocks in the weeks and months to come if the stock market truly believes that we have a legitimate vaccine that will work and that we have it in mass quantities to deliver to a majority of our population, and we don't have any unintended consequences, and you can go on and on and on with the ifs and the buts. But the point is, if the stock market believes that this vaccine news from Pfizer is legit, there is a major unwind that could take place here between value and growth, and we might just be getting started with that. So keep your eyes on that. That's a really, it's probably the most important thing that is happening in the stock market this week. Another way to kind of understand that concept is to look at discretionary versus staples. Here you're kind of seeing the same thing. It's not quite as violent as what we're seeing with growth stocks and value stocks. Part of the reason behind that is there are a lot of discretionary stocks that became value stocks because they were on the wrong side of the coin. In other words, some discretionary stocks like Amazon represented the new economy and the so-called coronavirus play, the e-commerce plays. But there's a lot of other stocks out there. Think of like Gap stores, or one of the dividend aristocrats we talk about quite a bit in my classes, VF Corp, the company behind the North Face and Vans and brands like that. A lot of those retailers, remember, they're going to be considered discretionary stocks as well, but they're not necessarily considered e-commerce stocks. They still need people to go out and shop. And so discretionary is not quite as clear-cut as growth in this particular conversation. Yet you can still see that kind of mindset taking shape here. If I were to look at the 1 year time period here with discretionary versus consumer staples, it's kind of the same thing where consumer discretionary has been crushing the consumer staples, largely because of stocks like Amazon and a little bit of Home Depot and a few of these other big box stores that were open during the coronavirus crisis. But if you were to kind of zoom in to just the 1 month view right now, you're starting to see the staples kind of take back some of that leadership role. And it's not that the consumer staples are zooming right now. It's just that those big e-commerce plays like your Amazons are starting to struggle along with the rest of the coronavirus plays that are out there. Another fascinating one is right here. Equal weight versus market cap weight. And this is specifically for the S&P 500. And you're noticing a major shift that's taking place here. Let me do this. Let me show you the 1 year view. And this one is actually starting to break out just right now. Notice that equal weight had been falling. I think you should be well aware of that. David and I had mentioned countless times over the past year how this was a market that is effectively being led by FANG. And another way to think about that is FANG is effectively some of the largest companies that are in the S&P 500. Your Amazons and your Facebooks and your Googles are among the top 10 holdings of the S&P 500. So when FANG is firing in all cylinders, you're effectively saying this is a market that is being driven by market cap, not being driven by equal weight status. Equal weight is when you would take the 500 stocks of the S&P 500 and apply an equal weight to all 500 of them. Market cap weight is saying we are going to put extra emphasis on stocks like Amazon and Apple and Microsoft and the biggest kahunas out there. So the story of the last year has been the market cap weighted big boys of the tech world have dominated while the rest of the stock market has effectively gone nowhere. And that is kind of manifesting itself in this 1 year chart here. But notice what has taken place at the end of this chart. We are seeing a curl up take place. So if I were to look at a 1 month chart here, look at the difference here. It's kind of similar to what we just talked about with growth versus value. All of a sudden, you can make the claim that equal weight is beating market cap weight. That's an important consideration. And I might add it's somewhat healthy as well. It's basically saying we have more of the soldiers advancing and not just the generals of the army. Another one that you'll recognize that's kind of been in place a little bit longer than the others, right? We've been talking about the fact that the Russell 2000 has looked better than the other three indices here for the last, let's call it, month and a half or so. You can see that very clearly here in this ratio chart of small caps versus mega caps. In other words, IWM for the Russell 2000 versus DIA for the Dow Jones mega caps. And we are starting to take shape with that trend change as well, where small caps are now starting to assume a leadership role. Now, before I forget, going back to the conversation here with equal weight versus market cap weight, I did want to show you something as well. Remember, the S&P 500 was down today. It wasn't down a lot, but it was down 0.14%. Most people, when they see that, they assume that, okay, well, if the S&P 500 was down, then most stocks in the S&P 500 was down. That did not happen at all today. In fact, today was a very strong day, positive market breadth. Notice what's going on here when I pull up the index watch on the S&P 500. Advancing issues crushed the declining issues. 323 stocks advanced for 176 that fell, yet the index itself was down. And again, the reason behind that is the S&P 500 itself is a market cap weighted index. So it masks the underlying strength of a day like today and probably a day like yesterday as well. From a market cap basis, we are struggling right now because the big tech stocks are struggling. From an equal weight basis, we are benefiting right now because all of those extra banks and oil companies and industrials and all those other companies that aren't really that fun to talk about in comparison to the tech stocks, they're all starting to see a nice wave of movement into them from an investor perspective. So, don't let the end result of today's S&P 500 fool you. Today was actually a broad-based rally. You're just not witnessing it directly through the index price. If you dig in a little deeper, you're going to see that way more stocks were up today compared to those that were down. All right, let's get into our trade application example. And for today's trade application example, I'm just going to come over here and look at chart 3A. This is our swing trading one grid here. And the stock that I placed a trade on is IBM. And remember, this trade has already been filled. For those of you that are premium members, an additional perk that you get in addition to all these fancy charts that you see us use is that you can sign up for our Telegram app and be alerted anytime David and I are placing trades. And so the way that I do it is I try to place the trade that I'm going to talk about in the free YouTube video later that night. I try to place that trade within the last half an hour of trading during the day, so that way those of you that are premium members of Market Scholars can look at what trade I implemented and consider it for yourself. It gives you an information advantage over everybody else. It allows you to place trades earlier than everybody else that would only be able to place these trades the next day. So this trade has already been placed, as is always the case with my trades. And what I chose to do was a bear call spread on IBM. Now, part of the reason behind that was what I was mentioning before regarding technology, right? Technology is falling out of bed right now. It looks like it was good last week, but in real time, it's fallen a couple of slots. Of course, IBM is one of the biggest technology companies out there. Now, granted, I don't know if I would really call IBM a tech stock that has performed in the same way that most tech stocks have. So there is a possibility this trade is the wrong direction. I have to recognize that. IBM could also be lumped in with value stocks. So there were certain tech stocks that were out of favor for the last year. IBM was one of them. So is it possible that IBM could continue to rally along with all the other value stocks, even though IBM itself is a tech stock? Yeah, I think it is possible. But the reason that I was comfortable doing it in this case is because I noticed IBM come up to its downward trending 30-day moving average yesterday, bounce up, and then bounce down off of it. So in other words, it got through the moving average briefly yesterday, but then pushed back down and actually closed near the lows of yesterday's session with a long upper shadow. Now, it was up today. It actually was up 2% here today, but it still wasn't able to overtake that downward trending 30-day moving average. Now, when I was looking at this, as I typically do, I go through a number of charts to see what trade applications I want to present to you guys. At the time I was looking at it, it actually had its blue line falling. In other words, this blue shading on the chart didn't exist at the time when I had selected it during the trading session. But by the end of the day, it had rallied a little bit more and was able to curl this blue line up. I know you can barely see it. It looks flat to me visually here, but technically it did go up just a hair. So the background color of that chart did flip to blue there, telling us that from a near-term perspective, there was a bullish posture at the end of the day. But I think in this case, I'm not overly concerned about that. I'm going to keep my eye on it, but what I'm kind of thinking in my own head right now is that IBM is clearly a market underperforming security. Here's the S&P 500 dotted line way up here. IBM is woefully underperforming the market during that time period. We still have a downtrend on our hands with IBM that it has not yet overtaken. So we're still below that falling 30-day moving average. We had a oversold cluster signal here, in fact, 2 days in a row. So you can see those two little green dots there telling us that we had oversold cluster signals. So am I surprised we got a reversion to the mean type of a move? No, not at all. The question is, was that a trend-changing type of a move? And the jury's still out on that. It's possible that IBM, if we get a big move into value stocks, could continue to benefit from that move. On the other hand, just pure technical analysis suggests that this is a stock that has struggled time and time again to regain its composure above its moving average in the past. So if you're going to do bearish trades, you want to do them when the pricing is right. In other words, you don't want to do a bearish trade on IBM down here when it's already broken down and already considered oversold with these cluster signals. You want to get better pricing on it by waiting and being patient for better setup. And in this case, I've waited until it came just to the underside of that falling moving average right there. So what I chose to do was to sell a bear call spread. Again, the details are for those of you that are in the premium membership group, are in the Telegram app. but you can see where my break-even price was. It was 123.49. I actually did a $2 wide bear call spread, and it was a weekly contract, not the normal monthly contract. So check your Telegram app for details on that. But basically, for those of you that are watching the free YouTube video, what I'm hoping to accomplish with this trade is for IBM to stay below this blue line here until expiration date. So I've got a little bit of up wiggle room there, but what I'm hoping for initially is for IBM to start struggling right here at this downtrending 30-day moving average. In my ideal world, you want to see this bounce back down lower. Now, if it doesn't, I've given myself that extra wiggle room. If it continues to go higher, it just doesn't go above the blue line, I can still win this trade. But I'm kind of hoping that it starts stalling out at around this level. Okay, so that's what I had for you here tonight. As always, I really appreciate you guys checking out this video. This was a little different than my typical routine, so I hope those of you that recognize that appreciate that. And if you do, be sure to click like for me there on Twitter, as we talked about a lot of different things here in tonight's video with those ratio charts and the intra-week change in the sector rotation that we are witnessing. Lots of really interesting things taking place in the market in the last 48 hours. So as always, thanks for checking out the video. David will be back with you tomorrow, and I'll look forward to working with you all in a presentation down the road. Take care, everybody. Bye-bye.